and when rapid speed down to 2500.
Give point wherever you reduce speed to 180.
Black Box.
Hello, welcome back, KP's Black Box. Today, I have the opportunity to introduce you guys to one of our newest hires in the firm, Mr. Wes Gomez, or Wesley, if I'm calling you by your full name, right?
Aloha, Kenny.
Aloha. Wes is Irish, as you guys can tell.
Actually, I'm part Scottish.
Are you?
Yeah.
I'm trying to make a joke, and
Yeah.
now you throw that at me. So, Wes is from the Big Island. The Big Island being Hawaii.
That's right. Aloha, everybody.
So, welcome aboard. Wes is taking over KP Wealth Management, or Kenneth Porter Wealth Management. He's going to be our lead, or not going to be, is fully onboarded, hired as our chief investment officer, chief risk officer, chief compliance officer. What am I missing?
A little bit of everything. Bottle washer, mopper, sweeper.
Yeah. What's your favorite thing to cook? So when we make you chief cook.
Favorite thing to cook? That's a good question. Breakfast. I love breakfast.
Breakfast food.
Yeah.
I knew I liked you for
I'll
a reason.
do country ham, bacon, sausage. I'll make eggs, waffles. I'll have rice in there. I'm Asian. Hash browns, a little bit of everything. So
Asian persuasion.
yeah.
So rice at breakfast is
I'll eat rice 3
appropriate.
times a day. I'll have it for a midnight snack with something. Eggs and rice, if you haven't had it.
Oh, I have had eggs and rice. Kathleen loves eggs and rice.
Oh, yeah. It's a great dish. Simple.
Yeah.
Put a little soy sauce, or shoyu, as we call it in Hawaii.
Shoyu?
Yeah.
Okay. I learn something new every day. Well, man, it's great to have you here. It's great to have you on board with the firm. I'm looking forward to many years of growing in advisory with you. And so I wanted to welcome you on the podcast so everybody could know, put a name with a face. And today I just want to have a conversation with you about, your background, family history. That's, obviously important in our firm, and it's important in the culture. And,
Yep.
so talk about that today, and then we'll want to dig in and hear your thoughts on the markets, and you can wax eloquently for our audience.
Yeah. So a little bit about me. I'm 46, born in 77. My background, my dad's full Filipino. My mom is Okinawan, which is Japanese, Hawaiian. So mom was pregnant in high school. Dad didn't know what to do, so he joined the Air Force. And so I was made in Hawaii. I counted back the months. I was actually born at Keesler Air Force Base in Biloxi, Mississippi. We lived in Mississippi, Maine, Montana, Oklahoma. I loved Oklahoma because we had the stealth fighters there.
Right.
During the early 80s.
Those are so cool.
I love the air, but I was in the Air Force. I love seeing the military planes. And then he did about 12 years, got 3 degrees, and then got hired by Westinghouse in Baltimore. So we moved from Oklahoma to near Baltimore. And he works on the AWACS. That's all I can say.
Airplanes with the big disc
With
on
a big
top.
dome on top. And then eventually, I forgot what year it was, but then Northrop Grumman bought them out.
Yeah.
He's been there, I think, almost 30 plus years. He's not going to leave until they kick him out. He loves his job. But yeah,
Well, shout out to Mr. Gomez.
Dr. Daryl Gomez. He's a doctor. Yeah, he's got a doctorate. Yeah.
PhD. What's his PhD in?
Systems engineering.
Systems engineering. Dr. Gomez.
I can't explain
that. We'll get to meet him here in the near future.
Yep.
And Mrs. Gomez,
She's the horse, man. She's the thoroughbred. She worked.
she tells the doctor what to do, right?
Yeah, she worked so hard entire life. So funny story. My parents met in Hawaii. They went to rival high schools, and they built a brand new McDonald's in between those high schools. So then my dad went to Waipahu High School. My mom went to Aiea. They both got jobs there, and I always joke they met over the fry vat. And then I was conceived in the walk-in fridge. I'm just joking.
Brown
yeah,
chicken, brown cow.
that's how they met. And then the dad joined the Air Force, and then wherever we moved, there was a McDonald's. So, military, married, you're not making that much money. I mean, parents were broke. I mean, military in the early 80s, I mean, bought their first house. Interest rate was like 15, 16%,
Wow.
but they made it happen, and my mom worked so hard. She worked her way up to being a store manager and a regional for what do you call that? A franchise owner.
Okay.
I think owned like 10 or 15 McDonald's.
Wow.
She was like the regional and would like do all the training and handle the dollars and all that. So McDonald's, I mean, that's home cooking to me. I grew up on it. I had
I still love a good quarter pounder with fries and
me
and a
too.
Coke.
Me
Like
too.
on a hot summer day, man, that's a great
Yeah.
combo.
And then when I was growing up, I had like 50 or 100 of every McDonald's toy that came out. Like,
Man, if you still had those today,
some of those are worth a pretty penny.
yeah,
Yep.
that's wild. And one thing we'll have to talk about just a little bit in a little while, but I want to get to our toast real quick. But you, one of your side hustles with your dad is you guys trade on like a Japanese eBay. Is that
Oh, it's Macari. Yeah.
Macari.
So my dad actually has written 4 coin books. It's
Is
pretty
he
interesting.
Is he a numismatic?
Yes. Yes.
Wow.
Yep. Been doing it for years. Put himself through college by selling some coins that you bought in like the 70s. So that was like
That's
his
cool.
side hobby. And now I'm trying to learn about the coins, and I do sell on Macari. It's like the eBay, but it's started in Japan. Selling coins and collectibles like McDonald's toys, and just kind of vintage toys. I call myself like the vintage broker, so to say. So it's fun. You learn a lot. Keeps it interesting.
That's awesome.
Yep.
So, talking about the toast, and I want to make a toast to your father being a veteran. On my podcast, I always try to start out by just giving honor back to those that had served and those families that have served along with their mom or dad.
Yep.
And so it's really important to me, especially being a prior Marine, to always just give a toast back. And I know you're not a big drinker,
Yep.
right?
I will with you. But before that, I got to show you something. So, my dad was in the Air Force. My grandfather was in World War II. And so I keep both their dog tags on me every day. Even though I didn't serve, my grandfather or father, I mean, I love the military. They keep our freedoms.
That's right.
And I wear this every day. So I got my
That's
grandfather and my dad's dog tags. My dad's like, don't lose it, because the Social Security number's on there.
Right. Big time.
Yep.
That is awesome, dude.
Yep.
Well, cheers to your father and your grandfather. Thank you for your service, Mr. Gomez. And what was your grandfather's last name?
Gomez.
Gomez. He was
Yep.
owned.
He was
so
Pat
just-
Gomez. Yep.
Pat Gomez. Thank you guys for your service.
Dad,
Salute.
grandma, grandpa, and mom.
Yeah. You didn't have to kill it. You killed it.
Woo. I thought that's what you're supposed to do.
You did it. I was going to let you sip a little bit. Man, you went for it. Wes, we'll have to do a podcast one day and just talk about, family heritage.
Yeah.
That's stuff I love to just kind of geek out on. But, today, since we do have you here as the Chief Investment Officer of Kenneth Porter Wealth Management and interviewing you today, let's talk about the markets and just kind of dive right into what's going on currently, and then kind of the money philosophy of the firm and what makes us unique in this marketplace in terms of how we serve our clients. So tell me, starting out 2024, you got major predictions?
I mean, if I had a crystal ball, Kenny, I wouldn't be your CIO or president. I would tell you that. What I want to do, though, is where are we now?
Yeah.
Right? That's we always, no matter where you are in life, no matter what we're talking about, where are you? And so as investors out there, we need to make sure you understand where you are and kind of that look forward. So if we look...
Where you are to where you want to be?
Exactly. Yep.
Okay.
And there's not a silver bullet of kind of how to get from point A to point B. Everybody has different data points. Everybody has different wants, needs. A lot of people are emotional about money too.
Yeah.
So it really depends on us as advisors understanding the client not just from their financial data points, but also how are they as a person.
Yeah.
I think that's a part of it. I think that most advisors kind of miss out. You can get lost in the data, but again, how's that person feel?
So emotion plays into financial decisions, obviously. So
Exactly.
most people start with an emotion to make a decision, and then they try to use logic to define the emotion that they had.
Exactly.
What we're trying to approach this world with is logic and knowing that we're emotional creatures, but saying, hey, let's go back to the logical findings, to the data, and then understand how do we blend those two together.
Yep.
And in our firm, what's really important is bringing together investments, which everyone needs. Investments we can call publicly traded stocks, mutual funds, exchange traded funds, the bonds, the real estate market. Those are things that fall into your world.
Yep.
And we take your world and we try to bring it into the world that I grew up in, which is the actuarial science side of the face, which is usually referred to as those actuarial science products or the insurance products.
Mm-hmm.
You can't have just one. You need both.
You have to.
And you blend those two together to create efficient and effective income streams, asset growth, and the opportunity, or what we like to refer to as the permission slip, to stay invested in those investment side of your portfolio.
Yep. That's
Right?
correct. Yeah.
Okay.
Again, kind of keeping it simple, stupid, military acronym. What can you control? Right. There are many different parts you can control as far as investments, the insurance side, so to say. There's parts that we can't control, right? Like the stock market, for instance. So if you kind of, if you pull this chart up here, Jacob, what I'm showing you is the 150 years of the S&P 500 returns and where we ended up in 2024.
Yeah, you printed this out. Okay.
And if you've done anything in math, what does that look like?
Jake, can you bring that up?
Anything with, standard deviation?
Or can you expand that on your screen? Like,
yeah, let me...
Command plus, zoom in.
Oh, wrong one. So if you look at this...
My bad eyes, now I can see.
Yeah, if you look at this, so on the bottom, what this shows you is the return of the S&P 500, and it plots where that year ended up. Okay, so if you look at 2024, if you look at 2023, it ended up with a return from 20 to 30%. It was up near 26%.
So we had a high side.
We were on this high side. So if you look at this is a bell curve.
Yeah.
It's just classic distribution of data points.
Yeah.
You're going to have your outliers, but then everything's kind of in the middle. But what's interesting is that if you retired last year or this year, you're on a high, right? You made 26%, over a quarter of your money, but we're in a new year. Everything resets to zero. Where's this year going to end up? And, I don't want to be the bearer of bad news, but if we go to one of these 50% losses, you lose 50% just when you retire.
Yeah.
You need 100% return to get back to even.
And you have to think about the distribution phase. If you're losing money and you're taking income, that's an additional
That's a double
drawdown.
whammy right there.
Right.
I hate to say it, investors out there, everybody watching, but the accumulation phase, the growth phase, where you're saving, you're maxing out your 401ks, doing the extra contributions, that's the easy part.
Yeah.
Right? Now, you're up at this mountain. Now you got to descend down that mountain.
Yep.
And there's some weird stat I think you mentioned before about mountain climbing.
70% of mountain climbing accidents happen on the way down. Accidents and death, 70% happen on the way down.
Yeah.
It's insane. So, and that's very similar as we see in distribution phases. Like we were just working on a case before the podcast today where we got a gentleman who's saved $2.1 million, which sounds like a lot of money today. And it is. He did a good job. However, now he wants to go into the distribution phase, and gross, he wants to take a couple $100,000 a year. So we have to work through investment and actuarial science strategies to solve for $200,000 a year gross. So that means after his Social Security, which Social Security on this guy was between him
I
and
think
his wife about
60,
almost
65,
yeah.
something around there.
So that means the drawdown on that portfolio is about $135,000 a year.
Yep.
If we index that to inflation, 100-year average of inflation is what, about 3.15%, somewhere
Right over
around there.
3, yeah.
So that gets really sketchy as you go into the later years and you need more money because your purchasing power has been reduced by the stealth tax,
Yep.
inflation. So thinking through that, what do you see like in 2024? And you're looking at these. That chart was kind of cool, the one that you had up.
Yeah, I was going to bring up this one right here because we're talking about retirement mistakes.
Yeah, okay.
Inflation over the last 2-3 years, kind of since that pandemic started,
Through the roof.
everything's expensive.
Right.
Imagine retiring 3 years ago. You set your plan to these parameters. All of a sudden, inflation's up. What are you doing? Are you buying less eggs, less milk, less toilet paper? What are you doing?
I benchmark the pork, right? I think you've heard me say this before in some of my workshops, is that I love bacon, right? That's my favorite breakfast food.
It's my favorite condiment, actually.
That's right. So bacon, there's a favorite brand that I have, Wright's Bacon. Shout out to Wright's. We don't own Wright's, do we? We don't own any. So anyways, Wright's Bacon, it used to come in 3-pound packs. And you could go to Walmart and you could get 3 pounds of Wright's Bacon 3 years ago for about $16. Now, today, they're a little tricky. You go to Harris Teeter, you go to Walmart, you go to name the chain, and you walk in and Wright's Bacon, you can't find a 3-pound pack anymore. Maybe at the Costco or the BJ's wholesale clubs you can, but in the traditional grocery store chain, it's $1.50 pound, and it's about $21.
It's that shrinkflation.
Shrinkflation.
Yeah.
Explain that.
Basically, you're paying the same or more for less product.
So the manufacturer said, "Oh, well, we're not going to raise prices on you.
Yep.
We're just going to give you less quantity."
And it's hard to say. They'll take the time, design the box, the packaging just slightly different.
Yeah.
It may look the same just visually, just looking at it for a second or two, but when you actually examine it, there's less ounces, less things in the
shrinkage.
Less pounds.
Shrinkflation. Actually, it brings up a story with a buddy of mine who was a soccer coach for little kids. And he would give all the kids at the end of the game, he'd give them a Capri Sun, load them up with some sugar, and then he'd give them some Oreo cookies. And so there were, most of the time he'd have 12 kids, right? 11 on the field, 1 sub. Well, Oreo cookies came in packs of 36. So he's handing out 3 cookies to each kid. And he gets down to the 11th kid, and he runs out. Nabisco, who owns Oreos, had shrunk that packaging from 36 down to 30.
Oh, wow.
So I think it was by the 10th kid. Yeah, by the 10th
Two
kid.
kids missed out.
2 kids missed out on their cookies.
Wow.
And he was like, man, I wanted to write a letter back to Nabisco and say, hey, you want to let us know when you shrink the packaging? But it's funny how they did it. They made the packaging look very similar. They just changed the wording, how they shaped or moved the branding, and made it look like the same regular size. But they took 6 less cookies and charged more.
And they spend probably millions of dollars on the test marketing, right? They get the 10 people. Hey, do these packagings look the same and stuff? And then they go with whatever, and people are just blind to it because it's an automatic buy, right? They don't know until if you actually look under the hood.
Yeah, so feel free to go out there and fact check me on that. Oreos now, instead of 36 cookies in the big packets, it's now 30. Jake, you want to fact check me real quick on that? Well, I like to be accurate, but I remember him telling me this story about it.
That's so interesting.
And I know you don't have the chart up, but tell us why he's looking for that. Tell us
So
retirement mistakes here.
Top 10 retirement mistakes, that inflation part, we just spoke about that. This is another one.
So what does 49% mean? Underestimating the impact of inflation.
49% of the survey.
Of people surveyed.
Yeah. Of what are your, what are the mistakes you made if you could redo your retirement?
Got you.
Okay. So inflation, because that's kind of, top of mind the last couple of years.
Yeah.
People are living longer,
That's huge. That's huge.
So you have to make sure, and this is maybe the number one risk that me being an advisor over 20 years, most people don't want to outlive their money.
Right.
And so, Social Security is going to do so much. Did you save enough? If you have that bucket of money now, are there things that you can do now to ensure that you won't run out of money?
So statistically, and this is kind of my lane, right?
Yep.
So when you think about living too long, the insurance industry back in 2000 adopted the Harvard mortality tables. So the Harvard mortality tables went back over 20, 30 years, and they did some comparative analysis on mortality. And what they found was that the average human being on the planet now, instead of calculating life expectancy at age 100, they moved the bar to 121 years. So they said, hey, somebody on this planet, somebody who is either being born today or currently living, has the potential to make it out to 121 years old. And there's some in your in the Asian persuasion. There's some folks out there in the high Himalayas that are, I think the oldest living person right now that we know is almost 120 years old.
Oh, wow.
That lives, I think, up in the Himalayas.
Okay. I know in Okinawa, there's a lot of older people that.
Well, Japan has the oldest population in the world right now.
Yep.
And that's becoming an issue for them in their actuarial science, their pension plans, their retirement plans.
Yep.
The U.S. is on the heels of that.
Mm-hmm.
So we have to understand that in our retirement planning, and especially if you're giving investment advice, you have to get that consumer to understand that there's a high probability that they live a long time.
Yep.
And I think statistically there's one data point that you and I have talked about is that if you have two couples or a couple in a household, both over age 60, and they have not had a heart attack, stroke, or cancer, or had any dread disease, that there's a probability 1 in 4 are going to make it to their early 90s.
Yep.
So 25%.
Yep.
So 25% chance in that household, one of them is going to make it to the early 90s. Then there's a 50% chance that one of those two makes it into their late 90s. So when you're thinking about retirement planning, you have to plan for somebody in your household to live into their late 90s with your retirement distribution planning. And then the first one, you got to think about the inflation on that. What's your purchasing power?
Yep.
How long are you going to live? What type of pressure does that put on a portfolio?
Correct. And then what other pressure does that put on the heirs,
Right.
The kids, that next generation, and money's getting so tight right now, and it's about having a plan. Winging it's not going to work.
We're dealing with a client in Northern Virginia right now that is worried about this because they're both in their 50s. He ended up with a dread disease with MS. It's now, just taking over his body, and it's really bad, but it's creating long-term care costs.
Yep.
In his 50s. And then we have to think about, we've got the science says that, he may be taken away from this earth at an early age, but there has to be those assets left over for his surviving spouse.
Yep, the spouse.
Or she's got to go back to work at a late age.
Yep.
So in investment planning, when you're looking through these stats here, these are the things that you're having to manage portfolios against, all of those risks, right?
Exactly. These are, and again, these are risks that people really don't address until they're in that retirement red zone, maybe 5, even 10 years out. But if you really think about these early and often, it's about eliminating the risk, eliminating the things that you can control.
Right.
Right.
You said that earlier. Eliminate the things you can control.
Yep.
Eliminate the risk on
the risks that you can't control, right? Because the inflation, you can plan for that, right? Underestimating how long you live, you have good advisors, they can remove that risk or plan with that risk. Overestimating investment income. I mean, all of these you can address. What can we not control, right?
Yeah.
Let's look at the other end. What we were talking about earlier is, the direction of the market, right? And kind of going back to that first chart here, that bell curve of where the returns now are. Now, I'm not trying to make a prediction where 2024 is going to end, but if we kind of look at market history, each decade has a theme, right? So we look at this, the mega caps, and it's turning into what, the magnificent sevens. That's what
Right.
everybody's talking about. 2000 emerging markets, commodities, tech in the 90s, Japanese stocks in the 80s, et cetera, et cetera. So what is that theme? That's, we're already 4 years in, right?
Yeah.
Right now it's going to be that magnificent seven. But one thing that's interesting here, this other chart, right here. Oh, this is it right here. Stock market cycles. Again, if you're in that pre-retirement phase, 5 years out or so, markets move in cycles. I started in the industry in the year 2000. So we look at the year 2000, right? Let's say right around here, we've had two major upswings, but we've had some periods where people are losing a third of their portfolio, half of their portfolio. And, you could say we've had three maybe bull markets, so to say, in 1, 2, 3.
And if
count
you
this,
were the
4,
unfortunate
5.
person who retired during that downswing and you're now having to take a distribution from your portfolio, the time for you to be able to recover gets minimized, right?
It's hard.
Or actually get stretched. You don't have the time to recover. And I can remember some people in 2008 going, Kenny, I think I got to go back to work. And it's because of the timing and sequence, or what we call sequence of
returns, yeah.
And they were talking to me, this is before they were clients of mine, and they're like, I think I have to go back to work because I don't have the money to be able to take from my portfolio and have it survive over my lifetime. And so our job is to bring together actuarial science and investments to help a person see, well, what's the maximum income we can get safely?
Yep.
So,
yeah, and then if you just look at it at the stock market, that's the growth, that's the accumulation, right? In insurance, in a broad sense, that's the transference of risk, right? In investing in the stock market, you can diversify, you can add commodities, alternative strategies, things like that. You're just trying to smooth out that ride from eliminating the big ups and downs in the stock market.
Yeah, and when I hired you in the firm, one of the things I remember us talking about was taking an approach similar to Ray Dalio. Ray Dalio, one of the greatest hedge fund managers of all time. His advisory, Bridgewater Associates, in order to be in the firm, Wes, I know you know these numbers, but we'll just share it up there. But in order to be in Ray Dalio's portfolio, the minimum investment you have, hold on to your chair, $100 million minimum before you can even get a look. Your net worth has to be, and this was as of 2011, your net worth has to be $5 billion. Now, why did I say 2011? Because he shut the fund down in 2011 for new investors, which were basically sovereign nations or billionaires, multi-billionaires. But Ray started that from scratch, and he's one of my investment heroes. And one of the things I talked to you about is, hey, we need to build for our small investor, those that are, 100 million or less. We need to build portfolios that take into consideration all weather storms, all weather instances, whether it's a shiny, sunny, beautiful day, or we've got a financial hurricane on the horizon. The portfolio needs to be designed to mitigate and minimize those risks, and we associate storms with risk. So how do we have an all-weather position created for our clients? And that's where you and I put our heads together and say, well, why don't we bring together actuarial science with investments?
And one word I always like you saying, it gives us permission. Right? Because if we can eliminate certain risks on one end of that financial plan, that gives us permission to try to get that growth above the market. They call it alpha, right? Beating the market, right? If beta is the market. Again, it allows us to increase risk, but controlled risk, not letting the market dictate the risk that you have. I'm a chart guy. I'm going to have to pull up another chart here. So if we look at the S&P 500, I know a lot of people look at this. The SPY tracks the S&P 500. Diversification. you ask 1,000 people what diversification means, you'll get 1,000 different answers. Okay. Now, diversification as far as equities, we want to look at size of companies, large, mid, and small. Broad market is all large cap. You should know that. A lot of people do not, but hey, broad market's just the large caps. But when we go down here and look at the sectors, a lot of those people who are at retirement or in that red zone, you need to pay attention to this, because if you're tracking to the S&P 500, have the SPY or other investments like that, I wrote this down, 2/3 of the market of the S&P 500 is in 4 sectors. So let's say you have $1 million in the broad market in the S&P 500, your portfolio is pretty aligned to that. You have 300,000 in tech. Then you have, 110 in consumer cyclicals, 120,000 in financial services, and then 126,000 in healthcare. Those 4 sectors, that is 60% of your entire portfolio, of 4 sectors out of 11.
Wow.
So that is not diversification.
Doesn't sound all weather to me.
That's concentration, exactly, because if one of these go down that you have a lot of weight in, you're going to go down and then more with the market, where if energy rebounds, if industrials goes up, consumer defensive, again, you want the opportunity to win across all sectors, not just 4.
Yeah.
Okay. Yeah. So again, you got to set, you're going hunting or something. We're going to set that trap right. If you only can catch, these 3 type of animals, you want to make sure you can catch all 10 or what have you.
Yep.
Bad analogy.
I'm tracking with you, though. That's the scary thing.
Yep.
I understand what you're saying. So I know you don't want to make predictions going out, but with a year like we're in now, this is 2024, this is an election year. When you think about past election years, the markets have performed really well, right?
I mean, I guess it just depends who gets in. I know one thing, there's going to be a lot of volatility this year.
Okay.
With just a lot of the headwinds that are out there. Where is this? What are the risks in 2024? I'm a risk guy. Here we go. A lot of people know this, but the weather.
Yeah.
The weather is, maybe it's just more news stories out there, but the weather is affecting more businesses across the globe.
So insurance stocks could be like property and casualty companies.
Exactly. So, a lot of those underwriters or the underwriters of underwriters, if there's a lot more claims out there, that's going to affect, not just those insurance companies, but those banks that those insurance companies bank with. I mean, someone's got to pay for, if Florida gets hit with a hurricane, someone's got to, pay those claims. This is something that's interesting. The AI, disinformation.
Okay.
Exactly. There's been reports out there that there's AI-generated influencers. They're not humans. People just generated them. They're stealing dollars and views away from real humans.
Mm-hmm.
And
from
so
real data. It's
a
facade.
It's a facade. So it's someone who's not even there, and then that just leads to disinformation.
Yeah.
Right. The other day we had something about the SEC approved the Bitcoin ETF. Right.
Yeah.
But someone basically hacked one of the, I guess, employees or something of Twitter, of X it's called now, and hijacked their handle, whatever you may call it. But I mean, disinformation, I think that it's as bad as high-speed frequency trading. Because the markets are moving on a dime. There's so much information, so many people are reading, and those algorithms are trading. And it's just, there's so much information. Who can decipher it the quickest is going to make those dollars, so to say. But there's a lot of bad information, and it's a political year. A lot of things can happen. So a lot of volatility.
There's a book written back, I think it was in 2011. I've been listening to it again on audio. And of all people, the philosopher, the coach, Tony Robbins. I love Tony Robbins. Been through one of his courses, week-long courses out in San Francisco. It was life-changing. But you never really think about Tony, quasi giving financial advice. But he wrote a book back in 2011 that took him a couple of years to write. Hundreds of interviews with financial experts, Ray Dalio being one of them. And I'm on that chapter now where raised talking about these risks, and these risks associated even back to 2008, 2009, 2011. These risks are what creates the volatility that we see in the market. But he made a really interesting comment, is that for every winner, for every guy that wins at the game, there's someone who loses.
A zero-sum game.
Zero-sum game.
Yeah.
And that was his exact quote.
Yep.
So in that world, he goes, what we have to look for is ways to diversify the portfolio against all these risks and take into consideration those variables that play into your retirement distribution plan.
Mm-hmm.
And so that's, one of the charges that we've had for you is, hey, when you're managing money for clients, we have to think about these pre-retirees, retirees, business owners, and their succession. The money has to last. The money has to be there.
Yep.
And so we have to protect against these short-term, long-term impacts on the market.
Yep.
Any parting thoughts today? Any other charts that you want to share that kind of helps consumers understand a little bit about the money philosophy that we'll use?
Yes. This is something that I don't think it gets much attention, but I just think it speaks volumes. So this article comes out every year. CNN last did it on June 9th, 2023, and it's right here. So the count of publicly listed companies traded on the U.S. exchanges has fallen substantially from its peak in 96. Back then, the number of publicly traded companies were 8,000. Today, that count has dropped by more than 50% to just 3,700. Okay, so why is that important? All right, so I like to look at the public, the trading, the exchanges as a whole view, 50,000-foot view. If there were 8,000 companies back in 96, and now half of those are gone, think about this. There's trillions of more dollars invested in the markets today on half the board, on half the companies.
Yeah. And most of these companies, to go from 8,000 to 3,700, most of it, I guess, happened strategically, right? Where these companies bought back their stock, they delisted.
Bankruptcies,
Okay.
delisted, going private, acquisitions, right? But again, as people under 100 million investors,
Right.
There's 3,700 companies to invest
choose
in.
from. Yeah.
And there's so much more dollars on each of those companies. So the point I'm trying to make is control what you can, make sure you're diversified, and not just on the equity side, but on the actuarial science side. Because equities is not the answer to all the problems. You have to look at the planning side and then look at, hey, do insurance make sense? Do fixed index annuities? Does equities make sense? Do variable annuities make sense? You have to have an open mind because, I've been on the equity side for 20 plus years. They're going to preach you that's the only that's the only solution. That's your salvation. That's your saving grace to get from point A to point B.
And pay attention to the fees.
That's the thing you got to look at. Every dollar counts. Right. And again, just kind of maybe the theme, control what you can. You can control how much you're paying in fees, how much you control advisory fees, planning fees, things like that. Negotiate. Doesn't hurt to ask.
Right.
Right.
The worst answer you could get is no.
Yeah.
Yeah. Well, cool, man. I just wanted to give everybody an opportunity today to meet Wes Gomez and to hear a little bit from the man. Those of you who have questions, feel free in our YouTube page to throw out questions. We'll keep an eye on that. Those of you who would like to reach Wes, how can they get hold of you?
WG at KennethPorterandCo.com.
KennethPorterandCo.com. They could also go out to the website.
Yep.
There's calendar links there if they want to
Correct.
have a one-on-one with you. That's available.
Yeah, and usually I just want to have a conversation. Tell me what's on your mind. Share some financial data, and let's make a plan or confirm your plan if you have one. These consultations are free.
Part of the plan going into 2024 with firm is to also have you weekly giving some insight like this, where we're going to have you Wes's Corner. I don't know what we're going to call it. but where you can give some insights, some market updates, and just help consumers kind of see what's going on in the world from the viewpoint and the philosophy that we use at Kenneth Porter and Company.
The Flying Hawaiian or something like that.
Flying Hawaiian.
There we go.
That's cool. All right, man. Hey, thanks so much. We're happy to have you here and excited to grow this thing over the next 50 years with you.
Yep, you too, man.
That put me at 104. So my kids are like, oh, God.
So make sure you're planning out to
100-year-old
115 now.
121.
121.
Yeah. 115, the IRS is trying to take a little from you, but we'll talk about that on a different podcast.
Awesome. Happy to be here. Happy to be on this, rocket ship. I think it's going to be good. I think there's a lot of growth here. And I'm excited to help a lot of people, not just with equities, but with other strategies out there, give you peace of mind at the end of the day. So
equities is just 1/27 of where your money can go.
It's just a piece.
Black box.
Aloha, everybody.
Peace, everyone.